Now, we are going to understand different terminologies which are used in options trading. Understanding them is necessary to communicate effectively. I am using the term underlying asset from beginning. Some may have heard it already, some may not have heard it. Underlying asset is a basic unit from which option price is derived. Like in farmer's example, property was underlying asset. Similarly, in markets, options value is derived from something. There are different types of assets which have options. Most commonly traded options are Nifty and Bank Nifty index. Then there are shares in futures and options segment which also have options. There are some scripts where options have good liquidity and some do not have any liquidity. We have to find out and trade only liquid options. In currency segment, USD INR pair has good liquidity in options, and once one of my friend had earned 10 lakh rupees in 1 hour by trading USD INR option in huge quantity. In commodity, crude oil has options which are fairly liquid. So these are common assets which are called as underlying. Then derivatives are products based on these assets. There are two types of options, calls and puts. These are derivatives of underlying as described. Futures are also derivative of underlying. Futures move in same manner like underlying with almost same move as underlying. Sometimes the futures are available at discount, means they are available below the price of spot, and sometimes they are available at premiums. Maximum times they are available at premiums, means future price is more than spot price or underlying price. This provides opportunity for arbitrage. There are some fund houses which specialize in this type of trading. However, we are not going to dig deep in futures because futures can be traded in similar way to underlying with help of technical analysis, and arbitrage opportunities are not very frequent. So we have discussed about underlying and example. In equity, there are many examples like ITC, HDFC Bank, Reliance, State Bank, and all the equities in futures and options segment. For index, Nifty 50 and Bank Nifty are most commonly traded. One may consider Nifty Bs and Bank Bs as equity of index. Then there is commodity like crude oil and currency like USD INR which have good liquidity in options. We will discuss index options and stock options mainly, but principles are valid for all assets. There are various components to option contract. The term strike price means a specific price at which contract is written. In farmer's example which we have discussed, price of property was 1 crore. That is called as current market price or CMP. In that example, I had made a contract for price of 1.05 CR. That means 1.05 CR was strike price because contract was written for the purchase at 1.05 CR. If I had made a contract for 1.1 CR, then that would have become strike price. In share example of share X which we have discussed, at CMP of 100, 95, 105 were strike prices. Nifty has strikes at 50 point interval like 17,000, 17,000, 17,050, 17,100, 17,150, 17,200. In Nifty, 100 points strike are more liquid than 50 point strike, means 17,000, 17,100, 200, 300. These are more liquid. Bank Nifty has strikes 100 points away, like it has 38,000, 38, 100, 200, 300, 400 and so on. In Bank Nifty, 500 point strikes are more liquid in farther expiry, like 37,000, 37,500, 38,000, 38,500 and so on. For closest weekly expiry, options are more liquid near CMP. Stocks also have different strikes and they differ with respect to their market price. It is available in option chain on NSE website. The next component is premium. Premium is mutually decided price which buyer pays to seller. There are different components to premium which we will understand under different heading. For now, just keep in mind that there is a premium which is associated with options. Then expiry date is also a component of options contract. It is fixed last date on which validity of contract completes and option is said to expire. There are weekly contracts for indices and USD INR. There are mostly monthly contracts for every asset in FNO segment. Index expire on every Thursday and monthly expiry is on last Thursday of every month. When it's holiday on Thursday, then expiry is on a day prior. One must look for expiry date of contract before taking any trade. If Thursday is a holiday, then options expire on Wednesday or a day which is working day prior to Thursday. On expiry day, options are exercised if not squared off. What is meaning of exercising? It is a process of converting options into assets. Buyer has the right to exercise and seller has the obligation. Many terms will be repeated many times, but it will be useful. So call buyer has a right to get delivery at strike price. On expiry, call buyer pays seller the cost of underlying and takes delivery. Call buyer has to send a notice to exchange for this. Then all shares are physically settled on expiry. For this reason, one may have noticed that margin requirement for option selling increases near expiry for shares, not for indices, because indices are shared in cash, not physically settled. It is obligation on call writer to give physical delivery in demat account of call buyer if call buyer wants to exercise his right to buy. On the other hand, put buyer has right to sell shares at strike price. So at expiry, put writer may ask put seller to take delivery and pay money. There are two types of options. One is American type and another is European type. American type of options can be exercised at any time on or before expiry, whereas European type can be exercised only on expiry. Indian options are European style, hence it is denoted as CE for call option and PE for put option. These contracts are traded at any time but exercised only on expiry. That's why trading continues throughout the week, throughout the month till expiry, but it is exercised only on expiry. As we do not have American options for trading, we will not discuss anything about them. Index options are settled in cash without physical delivery. For this reason, margin does not increase near expiry. So contracts can be traded at any time but they are settled on expiry. Do you have any questions on topics covered so far? Now there are two parties in options contract. There is one buyer and one seller. These are two parties. Option buyer has right to exercise the option. Option buyer can convert option into underlying by paying amount at strike price. This way, if underlying price is at higher level, option buyer can still get delivery at lower rate. Option buyer can sell the contract to someone else and take pure profits. Option buyer gains if price moves beyond the break-even point. Means strike price plus option premium is the break-even point, beyond which if the price of underlying moves, option buyer will gain. For example, if call option of 105 strike price is bought at 5 rupees, then profit starts when price increases and buyer gets profit if expiry is above 110. However, for put buyer, if someone has bought put at 95 strike for 5 rupees, then profit will start after share price falls below 95 minus 9, 95 minus 5, that is 90. So if at expiry share price is below 90, then put buyer will gain. Then other party is option seller. They are also called as option writer or option shorters. Please remember this, option sellers are called as option writer or option shorters. Option seller has obligation to take delivery at strike price. It is said that option seller has unlimited risk. They have to accept the risk, and option buyer has limited risk. Option seller has to accept larger risk in case of move comes in opposite direction. They get profits even if there is no move after contract is written. Means if prices remain in the same region after writing contract, option seller will get profits. Option buying and option selling are diagonally opposite trades. They are diagonally opposite positions. Options trading is a zero sum game. That means profit of one person is loss of another person. When seller loses, only then buyer will gain. For both parties, starting point is same because contract is written by both parties at one point. One gains at the cost of other person. Here one person will gain and another will lose. It is not like investment in shares where buyer can gain without real loss to seller. Starting point for both buyers and sellers is same in options trading, whereas in share trading they are different. This is the reason that even if someone is gaining in share buying, it is not at the cost of someone else who is selling the share. That person might have bought shares at lower level. There are only two types of options, and symbol for calls is CE and symbol for puts is PE. Then there is a concept of correlation, positive correlation and negative correlation. Positive correlation means premiums increase when value of underlying increases. This is seen with calls. When index or share prices increase, premium of calls increases. That's why calls are positively correlated to underlying. On the other hand, puts are negatively correlated. When price of underlying falls, premium of put increases. Okay, I hope everything is clear till now. Does anyone have any questions at this point about whatever we have discussed till now? Now let us see properties of options individually. Call options are positively correlated to underlying as explained just now. Call buyer can call away shares from seller. What does it mean? It means he has right to ask a seller to deliver shares from call writer's pocket to call buyer's pockets. Seller has obligation to give those shares. For this reason, this option is called call option. Call buyers can call shares in his account. That's why they are called as call option. As a trader, we have two choices. We can buy a call or we can sell a call. It is a fresh contract. For newcomers, this is slightly tricky concept. Those trading in equity markets as investors just know one transaction: buy and hold. We know this transaction because we do it on day-to-day basis everywhere. We go to vegetable markets and buy vegetables from those who grow vegetables or bring it from farmers for sale. We do not know how to sell, especially because we do not have that product with us. But option is not a product. It is just a contract. Option writer gets premium for giving his consent to bear the obligation of delivery. Premium is received in return of obligation, and this obligation is valid till date of expiry of contract. Is this concept clear? Then what is view of a call buyer? Buyer's view should be strongly bullish. Call buyer's view should be strongly bullish. At the time of expiry, if price of underlying is more than addition of strike price and call premium, only then call buyer will be in profit. So, underlying must cover distance well beyond strike price for call buyer to have profits on day of expiry. What is view of call sellers? Call seller has a view which can be bearish or it can be sideways. Expectation of a seller is that by the time of expiry, stock will remain below strike price. Break-even price of call writer is higher than actual strike price due to premium received. So, call writer can earn profit even if underlying closes slightly above strike price at the time of expiry. Call writer this way has that extra cushion due to premium which he receives. Puts, on the other hand, are exactly opposite of calls. Put options are negatively correlated to underlying as explained earlier. Put buyer can put shares in put option writer's pocket. Means put buyer has right to ask the seller to buy shares from put buyer and put these shares in put seller's pocket. Don't get confused. Simply understand this. Seller has obligation to buy those shares, and for this reason this type is a put option. Put buyer has a right to put shares in seller's account at strike price. Similar to call options, trader can buy or sell put option. Put buyer does not have to hold put option before selling it. It can be a de novo contract. What is view of put buyer? Put buyer's view should be strongly bearish. At the time of expiry, if price of underlying is less than subtraction of put premium from strike price, only then put buyer will be in profit. So, underlying must cover distance well below strike price for put buyer to have profits on day of expiry. What is view of put seller? Put seller has a view which can be slightly bullish or sideways. Expectation of seller is that by the time of expiry, stock will remain above the strike price. break even price of put writer is lower than actual price of premium received. So put writer can earn profit even if underlying closes slightly below strike price at the time of expiry. Put writer also has that extra cushion due to premium received. Put buyer has right to sell, but there is no obligation to sell. Put buyer has right to sell fixed quantity at fixed price on or before expiry. There are 4 basic positions possible with options: buy call, buy put, sell call and sell put. Any buying position is called as long position. Any sell position is called as short position. This is going to be tricky, please pay attention. Call buyer is long in call and he has right to buy underlying. His view is bullish. Whereas for puts, this is different. Put buyer is also called long in put and he has right to sell underlying. His view is bearish. Call buyer is long in call is bullish. Put buyer is long in put but he is bearish. Opposite is true for sellers. Call writer is short in call and has an obligation to sell. His view is bearish. Whereas put writer is short in put and has an obligation to buy. His view is bullish. So, short does not mean bullish or bearish. Writing or selling does not mean bullish or bearish in options. It depends on whether it is call option or put option. Buying a call is bullish. Going long in call is bullish because call is positively correlated. Selling a call is bearish. Going short in call is bearish because call is positively correlated. Buying a put is bearish. Going long in put is bearish. Usually we understand long means bullish, but going long in put is bearish. Long means buying. So put buying is bearish because put is negatively correlated. People take long means bullish, but in put option this is opposite. Put long means bearish view. Then selling a put is bullish. Going short is not always bearish. Short is not always bearish. Going short in put is bullish because put is negatively correlated. People understand short means bearish position, underlying will go down, but in put option this is opposite. Put short means seller expect value of put should decrease. For that, value of underlying should increase. So selling a put is bullish. Have you understood what is long and short? Long means buying. Selling means short. Long means buying. Selling means short. It is not related to direction of underlying. It is related to instrument traded. Long in option means value of that option will increase. When I am long in put, I have bought put, so I expect price of put to increase. It will increase with fall in underlying. I am bearish on underlying and long in put. Is this clear? Is there any confusion in this? Now we will see difference of option position and future position. For futures, future long is a buying position. That means direction expected on underlying is upside. it is a bullish position, and up move is expected in underlying. Future short is a selling position. That means direction expected on underlying is downside. It is a bearish position, and down move is expected in underlying. For options, long and short has different meaning. Different meaning for calls and puts. Long position in option means buying of option is done. When view of underlying is bullish, long position is created in positively correlated option. That means in call option, which means we buy calls when our view is bullish on underlying. When view of underlying is bearish, long position is created in negatively correlated option. That is, we buy put option. Long position is created in put option. We buy put options when our view is bearish. So these are long positions in options. There is possibility of short position or writing in options. That means selling of option is done. When view on underlying is bullish, short position is created in negatively correlated option. That means we sell puts when view is bullish. We will see when to sell puts and when to buy calls for bullish view. Right now just understand these concepts. Don't ask question why should we not buy call instead of selling a put. I will explain this at later time. View on underlying is bearish. Short position is created in positively correlated option. That is call options. Means our view is bearish and we sell call. We can buy put. We can sell call when view is bearish. Similarly, we can buy call or we can sell put when view is bullish. When to do this, we'll discuss it. Any doubts on this? Any doubts about basics? Now let us see risk involved. For long positions in options, when we buy option, risk is limited and fixed to the amount of premium paid. More loss than premium paid is not possible in any circumstances if options expire worthless. Once we buy options, amount is deducted worth premium from our account and we are not going to lose more than that amount. But reward is said to be unlimited in this case. For short position in options, it is reverse. Reward is limited and fixed to the amount of premium received, but on paper risk is unlimited. Now here is another concept which option traders often speak of, that is debit trader or a credit trader. When we buy option, we pay premiums. Premiums are debited from our account, so option buyer becomes a debit trader. Strategies where premium paid is more than premium received are known as debit strategies. When we pay premium, it is debited from account. When we sell an option or we go short in options, we receive premiums. These premiums are credited to our account. So option seller becomes a credit trader. Strategies where premium received is more than premium paid are known as credit strategies because we receive the money in our account. Is this part clear on credit and debit trader? Debit or credit is not related to long or short. Is this clear? Are there any doubts? Now let us compare shares with options. Shares have some different properties as compared to options. Both of them are actively traded in markets. Buyers bid and sellers sell. Buyers bid and sellers offer their quotes, which can be seen in market depth. Dividends and voting rights are given to shareholders, whereas they are not applicable to call buyers or option traders. Options are derived from shares and they have fixed expiry date. Shares do not have any expiry date. Outstanding options contracts change constantly. That means number of contracts available for trading change constantly. New contracts can be created and old contracts can be removed. Whereas number of shares are fixed. Let me summarize again what we have seen till now. Long position in option means option buying. Option buyers have right to exercise the contract. We buy call when up move is expected and we buy put when down move is expected. Means long position in call options will gain if underlying moves up. Long position in put option will gain when underlying moves down. Option buyers are debit traders. They have limited risk and unlimited profit potential theoretically. Option buyers can exercise their right if option expires in the money. I will explain concepts of in the money, at the money, out of the money in moneyness part. Option shorters have obligation to get exercised. Call writers expect down move. Their view is bearish. Put writers expect up move. Their view is bullish. Writers can also have sideways view. Option shorters are credit traders. Their risk is unlimited and reward is limited. Option sellers can be assigned to fulfill obligation if their option expires in the money. This was summary till now.